Welcome back to my YouTube family. I want to start with a question that most financial advisors will never ask you, and the reason they won't ask it is not because they don't know the answer, it is because the answer is not good for their business model. Here is the question. If you could choose, right now, to put your retirement savings into a mutual fund that a committee of strangers at your company selected for you, that charges you fees whether it goes up or down, that you cannot touch without a penalty until you are 59 and a half years old, that limits you to whatever investments your employer decided to make available, would you choose that? Most people, hearing those terms for the first time, would say no. Those sound like terrible terms. And yet, that is exactly what a standard employer 401k plan is. That is not my opinion. That is a description of the structure. In a 401k, the investment menu is ultimately controlled by the plan sponsor and its fiduciaries. Every investment must be vetted, documented, benchmarked, and defensible under ERISA. That naturally limits what can be offered and tends to favor broadly diversified, institutional-style products over specific or niche opportunities. Now, I want to be very clear about something before we go any further. I am not telling you to stop contributing to your 401k. The tax benefits are real. The employer match, if you have one, is free money that you should absolutely be capturing. I am not arguing against 401ks. What I am arguing is this. The 401k was designed as a floor, not a ceiling. And the wealthy have always known that. They use the 401k for what it is good for, the tax deduction, the employer match, and then they build their real wealth building strategy in structures that give them actual control over their money. Today, I am going to show you exactly what those structures are, what the wealthy use, what is now legally available to people at every income level, and most importantly, the one thing that changed in 2026 that makes this conversation more relevant than it has ever been. Stay with me, because the last section of this video covers a change in federal law that happened in March 2026 that most financial advisors have not caught up with yet, and it directly affects what you are allowed to do with your retirement money starting right now. Quick note, if Wealth Logic helps you, subscribe and hit the bell. I cover retirement from every angle, including the angles most channels never touch. Now, let us get into the real structure of the 401k and what exists beyond it. What the 401k actually is and what it was designed for. Let me give you the honest history of the 401k, because understanding where it came from explains why it does what it does and why it was never designed to be your primary wealth-building vehicle. The 401k was created by the Revenue Act of 1978. It was not created to help workers build retirement wealth. It was created as a tax benefit for executives, a way for highly compensated employees to defer some of their income to avoid a higher tax bracket. A benefits consultant named Ted Benna noticed the provision in 1980 and realized it could be expanded into an employee savings plan. The 401k as a mass retirement vehicle was essentially an accident of interpretation, and it has been retrofitted onto the role of primary American retirement savings vehicle without ever being designed for that purpose. Here is what the 401k is genuinely good at. First, the tax deferral. Every dollar you contribute reduces your taxable income for the year. If you are in the 22% tax bracket, every $1,000 you contribute saves you $220 in taxes immediately. That is real and valuable. Second, the employer match. If your employer matches 50 cents on every dollar, up to 6% of your salary, that is a 50% guaranteed return on your first 6% of contributions. No investment in the world reliably beats a 50% guaranteed return. Third, behavioral automation. The money comes out before you see it, which means most people never miss it and never spend it. Behavioral finance research consistently shows that automatic savings outperforms deliberate savings for most people. So, what is the problem? The problem is not the tax benefit. The problem is the jail part. In a 401k, you are not constrained by liquidity requirements designed for daily trading, nor are you limited to investments that can be easily benchmarked against public indices, unless, of course, you are in a standard employer 401k, in which case you are constrained by exactly those things. The investment menu in most employer 401k plans contains between 8 and 25 mutual funds. Those funds are chosen not for their returns, but for their legal defensibility. The plan fiduciary, the committee at your company that manages the 401k, is legally liable if an investment loses money. So they choose investments that are impossible to sue them over. Safe, benchmark hugging, broadly diversified, generic. And here's the number that puts all of this in context. Larry Fink, CEO of BlackRock, has emphasized that the future of investing lies in private markets. JP Morgan's CEO, Jamie Dimon, agrees, noting that wealth creation increasingly happens in areas institutional investors access long before retail markets do. The CEOs of the two largest financial institutions in the world are telling you that wealth is being built in private markets, real estate, private equity, private credit, and your standard 401k gives you access to exactly none of it. That is the jail. And now, here is the exit. What the wealthy actually use. Let me show you the 4 vehicles that wealthy Americans use to build retirement wealth and that are available legally to any American with earned income, not just to millionaires, not just to people with connections, to anyone who knows they exist. Vehicle 1, the self-directed IRA. A self-directed IRA allows investors to directly select and control their investments, including private equity, real estate, and other non-public opportunities. It operates entirely outside the employer-driven fiduciary framework that governs 401k plans. You, not your employer, are making the investment decisions. There is no plan committee deciding what is appropriate for a broad group of employees. With a self-directed IRA, you can invest in real estate, private equity, private lending, precious metals, timber, oil and mineral rights, livestock, and more. The contribution limits apply as a standard IRA, $7,000 per year in 2026, or $8,000 if you are 50 or older, but the investment universe is entirely different. The most common use of a self-directed IRA is real estate. You buy a rental property inside your IRA. The rental income goes back into the IRA, tax-deferred in a traditional SDIRA, tax-free in a Roth SDIRA. When you sell the property, the proceeds go back into the IRA, again, tax-sheltered. You are building real estate wealth inside a tax-advantaged wrapper. This is something the wealthy have done for decades. Most middle-income Americans have never been told it exists. Vehicle 2, the solo 401k with alternative asset access. If you are self-employed as a freelancer, consultant, small business owner, or anyone with any self-employment income, including a side business alongside your regular job, you qualify for a solo 401k. And a self-directed solo 401k is one of the most powerful retirement vehicles in the tax code. For 2026, the solo 401k contribution limit is $72,000, $80,000 if you are 50 or older, and $83,250 if you are between 60 and 63 under the new Secure Act 2.0 catch-up provisions. $72,000 in 1 year into an account where you choose the investments: real estate, private equity, private credit, precious metals, all of it inside a tax-advantaged structure. The employer 401k your company offers caps out at the same limit, but restricts you to mutual funds. The solo 401k gives you the same limit with full investment freedom. Unlike IRAs, solo 401ks also let you borrow against your own assets, up to 50% of the account balance or $50,000, whichever is less, giving business owners liquidity without penalties. Vehicle 3, the HSA as a stealth retirement account. HSAs offer what is called a triple tax advantage. Contributions are pre-tax or tax deductible, growth is tax-free, and withdrawals are tax-free if used for qualified medical expenses. For 2026, the individual HSA contribution limit is $4,400. Here is what most people do not know about HSAs. After age 65, you can withdraw from an HSA for any reason, not just medical expenses, and pay only ordinary income tax, exactly like a traditional IRA. Before 65, medical withdrawals are completely tax-free. This makes the HSA simultaneously a medical emergency fund, a tax deduction, and a second retirement account, with lower fees than most 401k plans. Vehicle 4, the Roth conversion ladder. This is not a new account type, it is a strategy. The Roth conversion ladder involves systematically converting money from a traditional IRA or 401k into a Roth IRA over a period of years, typically in your early retirement years when your income is lower, so that the money grows and is eventually withdrawn completely tax-free. A properly structured solo 401k can enable total annual contributions of $72,000 to be converted entirely to Roth through what is called the mega backdoor Roth, enabling massive tax-free growth. Stay with me because Section 3 covers the thing that happened in March 2026 that most financial advisors have not told their clients about yet. It is a federal rule change that directly affects what you are allowed to do with your retirement money inside your employer's 401k plan. And I think it is one of the most significant shifts in retirement investing in the last decade. The 2026 rule change that changes everything. Here is the law change I promised at the beginning of this video. In March 2026, the Department of Labor proposed a new rule that would allow 401k plans to more easily include alternative assets, such as real estate, private market assets, and cryptocurrency. The proposal is a direct response to President Trump's executive order directing the Department of Labor and the Securities and Exchange Commission to facilitate expanded access to alternative assets in 401ks. Labor Secretary Lori Chavez DeRemer stated, "This proposed rule will show how plans can consider products that better reflect the investment landscape as it exists today." Let me explain exactly what this means and what it does not mean, because the difference matters. The Department of Labor rule creates a so-called safe harbor that can help shield plan sponsors from litigation. It identifies 6 factors for a plan fiduciary to objectively, thoroughly, and analytically consider when selecting alternative investments. The 6 factors are performance, fees, liquidity, valuation, performance benchmarks, and complexity. What this means in practice is that employers who previously avoided offering alternative investments in their 401k plans because of fear of lawsuits if those investments underperformed, now have a legal framework that protects them if they follow the 6-factor analysis. This removes the single biggest barrier to alternatives appearing in workplace retirement plans. The executive order that prompted this rule change was driven by a clear rationale. If institutional investors and high net worth individuals routinely use alternatives to enhance diversification and returns, then everyday retirement savers should not be locked out of those same opportunities. Now, what does this not mean? Under this proposed rule, plan participants are not going to wake up one day and find a bunch of standalone private equity funds, private credit funds, crypto funds on the menu of their 401k plan, said Aaron Cho, partner at Mayer Brown Law Firm. Investors can only obtain limited exposure through vehicles such as target date funds. And one analyst noted, "We remain skeptical that this will encourage fiduciaries to include alternatives in 401k plans until the courts have concurred that this language protects advisors from litigation." That means it could be several years before we see the real impact. So here is the honest summary of the 2026 rule change. The direction of travel is clear. The federal government is formally acknowledging that alternatives belong in retirement portfolios. The practical impact in your specific employer's 401k plan this year? Probably minimal. Which means the people who benefit from this shift earliest are the ones who do not wait for their employer's plan to catch up. They are the ones who use the self-directed structures that have already allowed alternative investments for decades. The real numbers, what this actually looks like. Let me stop being abstract and show you what this looks like in real dollars. Large institutional investors, pension funds, endowments, and sovereign wealth funds have long relied on private equity, real estate, infrastructure, and other alternative assets to drive returns and manage risk. That divide has not existed because alternative investments lack merit. It has existed because of regulation, operational complexity, and fiduciary risk. Here is a concrete example of what the self-directed approach can look like. And I want to be clear that this is an illustration, not a guaranteed return. Imagine you have a self-directed IRA with $200,000. You use that capital as a down payment on a small rental property valued at $350,000. The property generates $1,400 per month in net rental income after expenses. That's $16,800 per year going back into your IRA, tax-deferred or tax-free, depending on whether it is a traditional or Roth SDIRA. At the same time, the property appreciates. Over 10 years, if the property increases in value to $550,000, that $200,000 gain flows back into your IRA when you sell, untaxed until withdrawal in a traditional SDIRA, never taxed if held in a Roth SDIRA. The same $200,000 in an index fund inside a standard 401k, growing at the historical S&P 500 average of approximately 10% annually, would become approximately $518,000 over 10 years. Not a bad return, but it is entirely at the mercy of public market conditions with zero control over the underlying assets and subject to fees that compound against you every year. IRA Financial, the largest self-directed IRA platform in the United States, oversees more than $5 billion in assets across 27,000 clients, with alternative investments including real estate, private equity, private lending, precious metals, timber, oil and mineral rights, and more, all inside IRS-approved tax-advantaged structures. For investors who are already evaluating alternatives outside of their retirement accounts, the self-directed IRA is the most direct way to bring that same discipline and conviction into a tax-advantaged structure. In a 401k, you may gain indirect exposure to private markets through a fund that allocates 10 to 15% to alternatives. In a self-directed IRA, you can choose to allocate a much larger portion of your retirement capital to a specific strategy or deal that you understand and believe in. The risks: honest, complete, not minimized. I want to spend real time on this because the escape the 401k narrative, which you will find all over YouTube and social media, often glosses over the risks, and the risks are real. You deserve to hear them clearly. Risk 1. You are the fiduciary now. In a standard 401k, if the investment committee makes a bad decision, that is their problem. In a self-directed IRA or solo 401k, you are making the investment decisions. That means you bear the full weight of due diligence. A bad real estate deal, a private equity investment in a company that fails, a private loan that defaults. These are your losses. There is no committee to sue. Risk 2. Prohibited transaction rules. The IRS has very specific rules about what you can and cannot do with a self-directed retirement account. You cannot buy a property from yourself or a disqualified person. You cannot personally use a property held inside your SDIRA. You cannot make a loan to a family member through your SDIRA. Violating these rules, even accidentally, can result in the entire account being treated as a distribution, triggering taxes and penalties on the full balance. Equity Trust Company, one of the oldest self-directed IRA custodians, has been operating since 1974 and consistently emphasizes that any information is for educational purposes only and that investors should consult with a tax attorney or financial professional before making investment decisions inside a self-directed account. Risk 3. Illiquidity. A mutual fund in your 401k can be sold in one day. A rental property inside your SDIRA cannot. If you need liquidity in a market downturn or for an unexpected expense, real estate and private equity investments take time to sell, sometimes months. The illiquidity premium, the extra return alternative investments often provide, exists precisely because you are being compensated for locking up your capital. Risk 4. Fees and complexity. Self-directed IRA custodians like IRA Financial charge a flat fee of $495 per year, regardless of account size. Others charge asset-based fees that grow with the portfolio. On top of custodian fees, there are transaction costs, legal fees for real estate deals, potential property management costs, and accounting complexity. For smaller accounts, these fees can meaningfully erode returns. The honest summary: self-directed accounts are not for everyone. They're for people who have the knowledge, the time, and the discipline to act as their own investment committee, and who understand the freedom to invest in anything comes with the responsibility of making good decisions. Here is everything together. The standard employer 401k is a genuinely useful tax tool for the deduction, for the employer match, for behavioral automation, but it was designed within a framework that limits investment choice to broadly diversified institutional products selected for legal defensibility rather than optimal returns. The wealthy have always used a different set of structures. The self-directed IRA, which allows investment in real estate, private equity, private lending, precious metals, and more, inside the same tax-advantaged wrapper. The solo 401k, with a 2026 contribution limit of up to $83,000 for those aged 60 to 63. The HSA as a triple tax-advantaged stealth retirement account. And Roth conversion strategies that move money into permanently tax-free growth. In March 2026, the Department of Labor proposed a rule that formally opens the door for employer 401k plans to include alternative investments under a new safe harbor framework. The practical impact in most workplace plans will take years to materialize. The self-directed structures that allow these same investments have been available for decades and are available to you today. The risks are real. You become the fiduciary. Prohibited transaction rules must be followed precisely. Illiquidity is a genuine constraint. Fees add complexity. This is not a decision to make based on a YouTube video alone. It is a decision to make after consulting a tax attorney or qualified financial planner who specializes in self-directed accounts. But the door exists. It has always existed, and now you know it is there. Here's the question I want to leave you with. If you had full control over your retirement investments, complete freedom to choose what your money was working in, what would you invest it in? Not a fantasy answer. If you had the knowledge and the structure, where would you put it? Drop your answer in the comments. I read every single one, and I think this comment section is going to be one of the most interesting conversations on this channel, because most people have never been asked this question, and the answers reveal something important about what people actually believe about building wealth. If this video showed you a door you did not know existed, share it with someone who is putting money into a 401k every month and assuming that is the whole picture. Take care of yourself, and I will see you in the next one.